All right, every quarter, India's biggest companies drop their report cards, and it gives us a fantastic look at how the economy's doing. Today, we're zooming in on a real giant, ICICI Bank. We're going to break down their latest earnings report in about 5 minutes. So, the big question on the table is pretty simple. Just how healthy is one of India's biggest banks? We're going to treat this like a quick financial checkup, looking at all the vital signs to see if they're really in good shape. Okay, so here's how we're going to tackle this. First, we'll hit the profit story. Then we'll break down their growth engine. After that, a really important financial health check. And to wrap it up, we'll get the view from the top. Sound good? Let's jump in. All right, kicking things off with Section 1, the profit story. This is all about the bottom line, the numbers everyone's waiting for. How much money do they actually make? First up, check out this number. Nearly 171 billion rupees in core operating profit. Now, this is the profit from their main gig, lending money and other banking services. And it's up a really solid 6.5% from last year. That's a great way to start. And it gets even better. Look at the profit before tax. That's up an impressive 9.1%. What's cool here is this number excludes treasury income, so it gives us a super clean look at how the core business is doing. And the verdict? It's doing really, really well. And here it is, the grand finale for profits. The net profit. This is what's left after every single expense and taxes paid. We're looking at over 123 billion rupees, which is a steady 5.2% growth year on year. So what's the big takeaway from all this? It's super clear. It doesn't matter which profit number you look at, operating, pre-tax, or the final net profit, they're all pointing in the same direction. And that direction is up. We're talking steady, consistent growth across the board. Okay, so that naturally leads us to Section 2. We know they're making good money, but where exactly is it all coming from? Let's pop the hood and look at their growth engines, specifically their loan portfolio. This donut chart gives you a perfect bird's eye view. See that big slice? That's retail, loans to people like you and me, making up almost 43% of their business. The rest is mostly loans to businesses, big and small. It's a really nice, diversified mix. But here, this is where the real story is. Check out that business banking segment. It's exploding with nearly 25% growth. Wow! This is probably being driven by all the small and medium businesses in India's service and manufacturing sectors that need credit to grow. Now, retail and corporate loans are growing steadily, for sure. But man, that business segment is absolutely on fire. All right, time for Section 3, and this one is absolutely crucial, the financial health check. Look, fast growth is great, but is it stable growth? You gotta ask, is the bank taking on too much risk to get these shiny numbers? Let's dig in and find out. Okay, before we get to the numbers, there's a term you gotta know, NPA, which stands for non-performing asset. Just think of it as a bad loan. It's a loan where the person or company has just stopped paying it back. For a bank, the lower this number is, the healthier they are. It's that simple. And this is where we see some really good news. ICICI Bank's net NPA ratio actually went down. It dropped from 0.42% to 0.39%. Now, I know that sounds like a tiny change, but in banking, the direction is everything. It means that while they're lending more money, the quality of those loans is actually getting better. That's the textbook definition of healthy, disciplined growth. Okay, get ready for another big, important number that tells us a ton about the bank's stability. It's called the capital adequacy ratio, and it's sitting at a very, very strong 17%. But what on earth does that mean? So the easiest way to think about CAR is like a car's airbag or a financial safety cushion. It's the amount of its own money the bank keeps on hand just in case a bunch of its loans go bad unexpectedly. The higher the number, the bigger the cushion. And at 17%, ICICI Bank has a massive cushion. They are built to withstand some serious shocks. And that brings us to our final section, the view from the top. We've seen the what, all the numbers, but now let's talk about the why. What's the philosophy, the strategy that's driving all this? Let's hear it straight from the leadership. During the earnings call, the CEO, Sandeep Bakshi, said something that I think really sums it all up. He said they don't think about it as a choice between growth and profit. Instead, their whole game is about sustainable PPOP. Basically, that's just a fancy way of saying they're focused on high-quality profit that's been adjusted for risk. And you know what? This isn't just corporate speak. We've already seen the proof. Remember that falling NPA ratio and that super strong capital adequacy? That's what this philosophy looks like in the real world. Okay, let's circle all the way back to our first question. How healthy is ICICI Bank? Well, the report card is pretty stellar. 1. We saw consistent profit growth everywhere we looked. 2. Their loan growth engine is firing on all cylinders, especially in business banking. 3. And this is key, their asset quality is getting better, which means the growth is stable and not reckless. And 4. It's all guided by a clear strategy that's all about sustainable long-term returns. All signs are pointing to one very healthy bank. So that leaves us with one final thought to chew on. With a balance sheet this strong and a strategy this clear, the question for ICICI Bank really isn't if they'll grow anymore. The real question is, what does the next chapter of this sustainable, high-quality growth story actually look like? Something to think about. Thanks for joining me.